Have you heard of people buying and selling shares? Ever wonder what shares are? The short answer is that they are methods of financing for a public listed company. Before I start, I mentioned the term public listed company just now. Let me go through some basic information you need to know about a company. If you set up a sole proprietorship or a partnership, you will be held personally liable for any debts incurred. The unique thing about a company is that it is a separate legal entity from the owners. The term separate legal entity means the law treats the company and each individual owners as two different things. Hence, in the event that the company incurs huge debt such that it enters bankruptcy, the owners will not be made responsible to pay for the debts. This is a major advantage of starting a company. You might have also noticed that most companies have the term limited or LTD attached to its name. The term limited refers to the limited liabilities incurred by the owners. Please note that the company owners are called shareholders. A company can be further classified as a private company or a public company. A private company can have only up to 50 shareholders, whereas there is no limit on the number of shareholders for a public company. Also, a public company is allowed to obtain financing by offering shares to the public, which is what we are going to learn in this video. Please note that the shareholders of the company do not manage the company. This is contrary to a sole proprietorship and a partnership, where the owners are actively involved in managing the business. Instead, the shareholders will appoint a group of individuals, called the board of directors, to help manage the company on their behalf. Every year, a company must hold its annual general meetings. This is made compulsory by law. During the annual general meeting, the shareholders will be presented with the company's financial statements. More importantly, several important decisions or resolutions about the company will be made during the annual general meetings. This is where the shareholders will get to vote for or against a particular resolution during the annual general meeting. Such resolutions may include who to appoint as the director, who to appoint as the auditor, and whether or not the company should proceed with a future activity. Shares financing is also known as equity financing. Why? It is because one share represents one unit of ownership in a company. Therefore, when a company sells shares, it technically means the company is selling the ownership. So when you buy the shares, you pay the company money to become one of the many owners of the company. The next question now is, why would the public want to become owners of the company? There are several answers to this question, but one reason is to receive dividends. When the company makes profits, the directors may decide to pay some money from its retained profits to the owners. This sum of money paid to the owners is called dividends. It rewards the owners for their capital contribution. Shares are a perpetual source of finance. It does not come with a maturity period, and the company need not return the share price back to the subscribers unless the subscriber sells the shares directly to the company. A company can issue different types of shares, each with its own unique characteristics. The two broad categories is ordinary shares and preference shares. Ordinary shares represents a true ownership in the company, which means an ordinary shareholder is allowed to vote during the company's annual general meetings. Preference shares, on the other hand, do not give the shareholder voting rights during the annual general meetings. The dividends for an ordinary share will vary each year, and it is at the director's discretion. This is not the case for a preference share, where the dividends are fixed each year. I would like to draw your attention to two types of preference shares, cumulative and non-cumulative. If the company did not pay dividends for a particular year, the dividends will be paid in subsequent years for cumulative preference shares. However, dividends not paid for a particular year would be forfeited for a non-cumulative preference shares. For example, let's say the preference shareholder is entitled to a 5-cent dividend per share each year. In year 1, the director did not declare dividend, and in year 2, the director declared dividend. If it is a case of cumulative preference shares, each shareholder is entitled to 10-cent dividend per share for year 2, to compensate for the missed dividend in year 1. But if it is a non-cumulative preference share, the shareholders are entitled to a 5-cent dividend per share in year 2. The missed dividend in year 1 is not compensated in year 2. Preference shares will receive dividends before ordinary shares. In the event the company liquidates, meaning come to an end, the preference shareholders can claim their share of the company's assets before the ordinary shareholders. Now that we know what shares are, let's go through the accounting procedure involving shares. Please note that a company is authorized to issue shares publicly if it has a valid document called the prospectus. The prospectus will state how many shares the company is authorized to issue and the price of each share. To account for the issuance of shares, we debit cash and credit not share capital but bank trust. Mind you, issuing shares is not as simple as you thought because the company needs to comply with many laws and regulations to ensure that the shares are not scandalously issued. The bank trust is a liability account representing the cash received during the public offering of shares. It is only after the offer period is over then the company can recognize cash received as part of the share capital, that is, to debit bank trust and credit share capital. I hope you remember that share capital is an equity account. That's why share issuance is called equity financing. Sometimes a company's shares is oversubscribed. For example, the prospectus may state that the company can sell 1 million shares at $1 each, but at the end of the offer period, 1.1 million shares were subscribed. The company is not allowed to keep the oversubscribed share capital, so it must return the cash back to the unsuccessful subscribers. Debit bank trust and credit cash. Sometimes, a company wants to raise capital without diluting its shareholdings. That is, it wants to avoid offering shares to new shareholders who might end up dominating the company's shareholding and dilute the remaining shareholders' shareholding. In such cases, the company can consider rights issue, which is a privilege given to existing shareholders to buy shares below the offer price. It is usually presented in a ratio, for example 1-for-4 rights issue, meaning for every 4 shares a shareholder holds, he can purchase 1 share under the rights issue. To account for a rights issue, we debit cash and credit share capital. Earlier on, I told you that dividend is paid out of profits to reward shareholders for their capital contribution to the company. Intuitively, the company will pay the shareholders cash dividend. But did you know that a company can also choose to pay share dividend? Share dividend is a form of dividend payment where the company issues more shares to the shareholder instead of paying them cash to reward them for their capital contribution. It is based on a percentage, for example 5%. A 5% share dividend means for every 20 shares a shareholder holds, he receives 1 additional share as a form of dividend payment. What is the rationale for declaring a share dividend instead of a cash dividend? If the company is running low on cash, but does not want to disappoint the shareholder by holding their money without paying them dividends, share dividends is an alternative option for the company. Another reason why a company may declare share dividends instead of cash dividend is to offer flexibility for the shareholders. The shareholder can choose to either sell the share dividend in the stock exchange and get cash immediately, or continue holding the share dividend in anticipation for greater dividends in future years. The directors of the company will declare dividends during the annual general meeting. When cash dividends are declared, we debit retained earnings and credit dividends payable. When the cash dividends are paid, we debit dividend payable and credit cash. If the directors declare share dividends instead, we will debit retained earnings and credit share capital. Please remember that dividends must be paid out of profit. That's why we debit retained earnings when dividends are declared.